Hi, my name is Luke Norman. I'm the chairman at US Gold Corp with the CK project, or Copper King, in Cheyenne, Wyoming, and we've just recently come out with our definitive feasibility study ahead of development and production.
Luke, you see, man. Yeah, obviously numbers are out. Nice reaction from the market. Is it what you expected?
No, actually, it's been a little bit underwhelming. Look, with everything that's been going on geopolitically, you know, in the eastern part of the world, I think there's been a little bit of liquidity rush that's affected the gold trade as well, and we've all witnessed that. So I think a little bit of rebalancing has been put on hold by a lot of the larger institutions, etc. But no, I certainly don't think that we're reflective of rather impressive definitive feasibility study. Certainly not.
Well, okay. Well, let's break that down. Okay, and maybe think a little bit longer term. You did the numbers at 3,250, right? You still popped out. I mean, remind us of the NPV and the IRRs and the important numbers.
Yeah, the after-tax NPV is about $635 million, up from $230 million. The IRR, after tax, again, is just below 30%. And this is using kind of scheduling in terms of development and such by the independent, of course, the independents that put together the definitive. We actually think there's a hell of a lot more optimization to be done. So just the base case numbers are tremendous. And I think what we're working towards in terms of our development schedule is going to be even better. So
right, but how should we think about this in terms of, obviously, like, gold price is up, and if you did a spot price, it's even better. But is this about price leverage, or is it about the underlying project quality? What am I looking at?
Both. We've got tremendous leverage. We do. We had tremendous leverage to the price of gold. The sensitivities chart. I welcome anyone to go to our website. Within our presentation, you'll see a sensitivities chart that outlines everything, all the way up in $500 increments. But even at $4,500 gold, all of a sudden you're dealing with a $1.4 billion NPV, IRR of just under 50%. And realistically, $4,500 gold is where we're looking right now, and below spot. So this project's so well leveraged to the price of gold, but again, at the base case price, it does tremendously well as well. So, if we do look at spot and we start bringing those numbers in, you get into some pretty heady numbers. And again, I just don't think that we're reflecting that positive report yet, but it like everything in the marketplace, the market takes time sometimes to digest these things. We're only 2 weeks to the day since we released it, so it's slowly getting out there.
Okay, right. Well, let's kind of maybe look at some of those sensitivities. I know people can go look at it on the chart, because obviously all that kind of thing kind of affects payback time, etc. So in terms of the NPV, what is it most sensitive to? Is it the recovery, Capex overruns, operating cost inflation? What do we look at?
I mean, your sensitivities, obviously, metals prices primarily, but then when you look at our recoveries, we have relatively low recoveries on the actual mine plan. We're only recovering 70% of the gold. 30% of that gold is locked up actually in the tailings, and it's something we've only just started recently addressing. If I just refresh your memory, we came out with a feasibility study bang on 2 weeks ago, from the time of this interview, of course. The following day, we put out another press release with Blue Sky, and in there we addressed the fact that, there is close to 300,000 ounces of gold in the tailings that's not going to be left behind. It's pulverized rock. It's sitting on a fully lined containment area. So at some point, we'll be going in there to extract that. Now, we don't want to play around with cyanide in that part of the world, but I know I'm a little bit off topic from your question. But ultimately, within the metals prices, clearly recoveries are there, but we're going to get the recoveries even higher. There's a lot of good news to come in the next sort of 6 months or so around this project. Further,
are there any? Okay, you're looking at those sort of like this is all about driving this efficiency. Any other kind of credits that are in the numbers or not in the numbers, or would you expect to be able to improve?
Yeah, well, I mean, look, clearly there is the big elephant in the room, which is our waste material, our waste rock, what is still classified as waste rock within the definitive feasibility study, but is actually a highly sought after aggregate. And, people have heard mining companies talk about these opportunities before, and usually they don't play out. In our instance, 20 miles outside of a major township, just north of the Colorado border, with a huge amount of demand for this particular rock that we have, big data centers going in, etc. Well, we haven't valued any of that into the definitive feasibility study, but just under the reserve alone, there's between 800 million and $1 billion in situ of that rock sitting on surface for free. Again, we've got the gold still sitting in the tailings that we're absolutely going to unlock. So yeah, there's a number of credits, I guess, above and beyond this in the definitive feasibility study that we want to unlock and we want to present as value opportunities here in this year, in this calendar year.
Okay, you've described this project as relatively simple project, okay, and I'm trying to, as investors, kind of look at, well, where could the complexity come in? So, for a sense of how simple you think it is going to be, how much contingency is embedded in the Capex number?
I think it's about 17.5%, or approximately. Sorry, it must be higher. It's in the mid to high $40 million range of contingency built into that Capex. So we were very conservative. People used to look at our previous numbers in the pre-feasibility studies and balk and say that we were grossly underestimating Capex. And that was a fair knockback and a fair comment. We did come in over $400 million on this one from a previous forecast of $277 million. And why was that? Well, because, the pre-feasibility studies were designed for our permitting process, but when we got really into the line items, prices, the cost of development production obviously increased. But, as we look at it now, we've got, again, plenty of contingency money built into that forecast Capex. It is a very, very simple mining operation. It's exposed at surface. It's a less than 1-to-1 strip ratio in an open pit. Very compliant rock that is run through a crusher, grinder, and ultimately flotation circuit. So extremely simple method of recovery. Not the most, probably optimal form of recovery. I think, CIL on the back end of it would work tremendously well, and that's something we're going to explore. But, there's no real ticking time bombs in terms of the methodology of us building and extracting this gold copper concentrate, and a huge amount of international demand for concentrates, which I know you're well aware of, Matt. They're paying premiums for these things. Obviously, we wouldn't factor that in or ever want to price in the fact that there's such competitive tension out there for these high quality concentrates like ours, which is an extremely clean, high quality concentrate. The marketplace is paying premiums for these. So we want to get this up, running, and obviously delivering that to a voracious marketplace right now.
Well, look, I know you've got George B on, who we've interviewed a few times here. But you remind me again in terms of the build strategy, but EPCM versus contracting and or owner builds. What have we gone for again?
Yep. So we've done contract mining, for example, in this definitive feasibility rather than building out our own fleet. It just makes a lot of sense. Why? Because there's so much heavy iron in this part of the world. Heavy iron referring to earth-moving machinery. I mean, 90% of this operation is just earth moving. We're moving rock. So there's plenty of qualified contractors. It's the other beauty of this location. You've heard me harp about this before, Matthew. We're 20 miles outside of an established township where people choose to be there, choose to live there. Unlike, Elko in Nevada, where the majority of people come in there as a lifestyle choice to work in the mines. We're selecting from people who, are going home at night, not living in man camps, that they're working on our project. So plenty of qualified personnel, so why not do it all under contract? And it's more of a gig mining or gig employment kind of construct that we've used here. Everything from, again, electrical engineering, or if you need a diesel mechanic on site, you're just using a subcontractor. It's not like you need someone on your employee. So that really helps and benefits the project nicely too.
Absolutely. But in terms of things like with the feasibility study, how much of it was kind of quoted versus estimated, and how much more needs a little bit of work before you move to FID?
Yes, full line item quoted. There are a few items, obviously, that we actually are still working on and negotiating. For but we have contract ready valuations on the mining costs, for example, which is quite a bit higher than what it was in pre-feasibility study. But we still haven't sat down with these parties and really negotiated, okay, what do we want to do with all this wonderful aggregate that's there? Are you guys wanting to own it? Are you wanting to pay us for it? Or, are we going to be selling it to a third party? We've already had, as you know, Burlington Northern Santa Fe approach us, etc. So, yeah, some of these line items will actually come down. The other thing is, look, the entire construct of the definitive feasibility, of course, under SK 1300, is there's no assumptions on used equipment. It is all brand new equipment, Scandinavian and otherwise, which, of course, met some tariff overruns that we hadn't estimated in previously. But since then, we've found perfectly good, very viable equipment that's up for sale right now in the marketplace. So there's a chance that some of those lead items, those costs are going to come down and be delivered faster. But if you just take the definitive feasibility study as it stands right now, yeah, it is pretty lock, stock and barrel. We're going to adjust some of the flow rates, flow sheets in terms of how we deal with the ore. We think that maybe it's a little bit conservative under the definitive. That can be worked on a bit. But yeah, this project is very buildable with the values that we've presented.
Right, okay. So, well, obviously you're going with contracting for part or all of that. The contracting party, the contract between you and them is going to be really, really important. How much of that, how much of the work that you've done do they accept, and how much, therefore, are you able to hold them to certain production standards? In terms of not just the build, but potentially also into the operational component, because that's the important part here.
Yes.
That's where that'll affect your margin. So tell us about what that conversation looks like.
Okay, so most of that conversation, at least from the definitive perspective, was really held between the independents, Michael and Halliard, who are of course the authors of the definitive feasibility, and the contractors, with us kind of coming in and going, well, no, this is how we see it. I think that's a great place to have the run a mine pad, because it ties in very nicely here, topographically, etc. So you have those sorts of high level conversations. But yeah, now we will clearly now sit down and have more one-on-one discussions directly with the contractor. And I won't name the contractor right now, just for sake of heck, just in case that changes too. But they're ongoing, and they will be obviously a little bit more definitive, for want of a different word, I guess, as we embark on that earth moving process.
Because I think obviously in part of this, you're going to, I guess, different people looking at different aspects of the project. Like we talk about the recovery. At the moment, 71.5 up to. You want to sort of up to more, average numbers that we're seeing elsewhere. Bit of work to be done there. At what point do you sort of start tying people down to making sure that they do at least give you within a range in terms of that recovery? Oh,
we've done the metallurgy already. You throw a whisper of cyanide at it through CIL, and you're in the high, 97, 98% recovery all in by the time you bring it in. So we've got every good reason to go after that. And look, the other thing is, when you're doing something like this, Matthew, you never want to use a technology that's not as well recognized or and try and price that into a definitive feasibility study. You'd just be embarrassing yourself and never get the appreciation or respect from the street for doing so. But there are plenty of methods out there now that we can take our rock and try out and tie into our ultimately our processing, and many of those may not actually include the use of cyanide. Iodine, for example, which is reusable, which is extremely safe, is one that we're going to consider. It's used throughout Nevada now. It works tremendously well with sulfidic material, particularly ours is a low sulfide deposit. So yeah, we are absolutely going to be toying around, playing around in the back garage there with our metallurgy and working out how to get that 98% recovery. But we know already, just with the simplistic CIL circuit, it would work tremendously well. But yeah, we'll see. whether we have to use the cyanide word ever at this project, I don't think so.
Okay. Well, look, it's gonna be important for you guys to kind of get that nailed down. I guess obviously signal that to the market, because you want to drive the ASIC number down, which is sort of sitting around the 1,700 numbers at the moment. Will be helped by other kind of metal credits that you may be able to achieve as well. So I guess more of that to come from you guys in the near future, right?
Yeah, correct.
Okay. Permitting, I know you permitted for most things, or you permitted for everything?
See, I tell you, even some of the most sophisticated individuals, mining companies, others that we talk to, they're always incredulous. They're like, yeah, but there's got to be still an outlier. It's like, no, we are permitted to mine. We have every single outlier, from our wastewater management, air quality, you name through the list. We have every box ticked. By virtue, actually, by already starting, which we've done, started the entry road, basically the access road to the project. By proxy, we've initiated actually our permit to mine. So we're actually under mine permit right now, and our industrial siting permit too. So yeah, we have every single bell and whistle on the permit sheet. And I didn't realize that that's actually a question that's asked consistently, because there are so many companies that do proclaim to have permits but still have outliers. The other thing that can happen in other parts of North America, of course, is if you're on federal ground, is people could still challenge those permits to mine. Under Wyoming state law, they cannot. Now that it's been awarded, we've had those permits were laid to bear to the public, through 30-day periods and then rest periods and town halls and everything. So the permits that are awarded to us are not reversible or revocable. We're ready to go.
It gets asked a lot. In my days in banking, where we got caught out multiple times, you think you're all done, and all of a sudden you need a forestry permit, which holds up a couple of $100 million worth of project, or you do get those challenges late on and your project's held up for a year. We've had money returned to us in circumstances like that, because the company couldn't advance the project. So this is rarefied air indeed. Don't take it for granted. That's for sure.
Yeah.
So and because of that, the finance. I mean, we talk about the sort of sub $400 million capex number. Because of that, the financiers obviously find it a lot easier, and possibly don't have to assign as much risk to it, which has a effect on cost of capital for you. Obviously, decreasing the cost of capital for you. So, and with those conversations, what's the kind of process and the path through to FID, and then into solidifying some of those debt equity conversations?
Yeah, so we're just right in the beginning point of that right now. Oh, I shouldn't say the beginning point, because I've mentioned before to you in other discussions that we've received term sheets for over the last 18 months from interested parties, from everyone from off-takers, streamers, and beyond. I think that it's a fair assumption that everyone we talked to, and we reiterated actually probably 3 times when we put out the press release on the definitive, the importance of, hey, we are fully permitted. So yeah, that will be recognized with a rock solid definitive feasibility study like this. What it does is it frees up the spigots on probably more interested parties coming to the table, and maybe some competitive pricing and timing on the project finance. But we have seen indicative term sheets, of as high as 80% debt with 20% equity, with equity shown at premiums to market, etc. There's a lot of money out there right now chasing mining opportunities with not a lot of projects like ours that are shovel ready to go. So, and it's not a huge capex. That $400 million is a sweet spot. We're not in the $1 billion type range. Again, with the location of the project, logistics, pricing of contractors and everything coming in, right to our power coming to the gates at 7.6 cents kilowatt hour. All these things, they're kind of locked in. So we think we're walking into a pretty friendly environment for mining financing right now.
Sounds like. So remind me, how many ounces a year are you aiming for in terms of the ramp up and life of mine?
So the ramp up, that's still kind of, again, I spoke to the fact that the flow sheets from our perspective probably need a little bit more honing in. The other thing that occurred, of course, with the big separation between the price of gold and the price of copper, are actually ounces equivalent gets impacted by the trailing copper price relative to our base case, of course. Now, we all know copper is now trading up around $6 a pound and looks like it's heading much higher. So, funny enough, that'll bring our ounces equivalents up significantly. But we stretched the mine life from 10 to 11 years. So that on the per annum basis, of course, got stretched out. But we're somewhere in just under 90,000 ounces gold equivalents currently, and we're expecting that number to increase.
Okay. You're definitely up there. You're definitely up there. Right. So obviously, definitive feasibility study out, numbers look good, ounces produced good, margins will be what they are depending on a variety of different things, but look good. What you always get this asked when you've done something. What next?
Oh, I think you say what keeps you up at night? That's a constant question.
Well,
metal prices, whatever else. Yeah.
No, not that.
Yeah.
What do you do? What now? What do we focus on now?
Well, again, bringing in all this additional value, the blue sky. Look, we've got another 1 million ounces that we can foresee, containable 1 million ounces that didn't fit within the reserve category. But between M&I and inferred, there's close to 1 million ounces. Why not recategorize that, spend some money drilling, bring that in? I mean, hey presto, you double your NPV almost just with another 1 million ounces in the reserve, because it's, your Capex is already covered. The definitive feasibility doesn't change. You just have a larger reserve to go after. So that clearly, monetizing the aggregate / waste rock. I don't know why we still use that term, but we'll refer to it again as aggregate. And I don't mean monetizing as in us trying to go out and market in the big boys' place, against concrete companies and Martin Marietta. I mean actually finding one of those companies, come in and partner and monetize that aggregate, maybe bringing down mining costs. So a lot of sweeteners coming still for this project, and that's what we're going to work on while we're doing the boring bits, which of course is project finance. So there's going to be a lot of news coming out of us. And ultimately, Matthew, we can't put our blinders on. We also know that when you do go to project financing at this juncture, when you've got a positive definitive feasibility study out, clearly the hawks start circling. They're looking. There's companies interested in M&A activity or pure takeouts on the project. So I think we're going to have a lot of balls in the air and a lot of work ahead of us this year, and plenty of news.
Okay. We'll look forward to it. It's a bit of resource expansion, opportunity, life of mine extension, and maybe more to come. We haven't talked about these
and recoveries too. Sorry,
I was about to say we haven't talked about the recoveries in any great detail, and maybe even that ballast stuff opportunity you talked about in a while ago with me. Look, 2026, year of execution to you guys. Keep doing your thing. Stay in touch.
Yeah, thank you. Thanks for having us.